conversation on this particular measure. We've got Marc Goldwein, Committee for a Responsible Federal Budget, Senior Director of Policy. Marc, let's start with the inflation picture, because this is called the Inflation Reduction Act. How far does it go in bringing down inflation?
Look, this bill is not going to get us from 9% inflation down to the 2 to 3% it should be. What this bill will do is make the Federal Reserve's job just a little bit easier so that they can fight inflation with fiscal policy moving in the same direction, not the opposite direction.
Hey, Marc, it's Brian Chung here. As a follow-up on that, you've actually outlined that there's a difference between what the inflationary implications of this are in the micro, macro, and then the full effect, right? And we have to remember that there's so many different provisions in here when we talk about ACA subsidies, energy, climate reform. So can you just maybe give us a little bit more detail on what you just said? That's going to be a longer-term process that also depends on exactly how you're looking at the inflationary implications as well, right?
Yeah, I think that's right. But the good news is, almost however you look at this bill, it's going to be helpful for inflation. Macroeconomically, it's going to take some excess money out of the economy, which we need when demand is so overheated. It's also going to lower drug prices. Microeconomically, it's going to reduce the prices, that sticker prices that people and businesses see for energy, for updates to their homes, for healthcare, for drugs. And all of that is going to hopefully positively feed into inflation expectations. I don't expect the effect to be large, but the direction is pretty clear, and it's going to help make the Fed's job easier.
What kind of timeline are we talking about? Obviously, lawmakers are looking at a calendar right now saying, well, what does this mean for the midterms? They can take that to the voters and say, look, we have a win. But at the end of the day, if they don't see a reduction, they may not necessarily buy that. Are we talking medium term, long term? Talk to me about the timeline.
No, look, the only thing that's going to happen in calendar year 2022 is the regulatory reforms that are accompanying this. So, for example, permitting reform and opening up of various sterling, that might help a little bit. But really, this is a 2023, 2024, 2025 game. What this is supposed to do is help stop inflation from persisting over the long term. Again, make the Fed's job a little bit easier. It's not going to provide relief next month, and we shouldn't expect that.
Marc, let's talk about the deficit implications of all of this. Manchin making it very clear exactly how he's viewing the bill. From where you stand over at the CRFB, how are you kind of evaluating the deficit implications of all of this? They say they're going to pay for it with that 15% corporate minimum tax, but is it squaring up like the senator is presenting it to be?
Yeah, it's not only this minimum tax. There's also a lot more money from improving tax compliance and lowering drug costs. Overall, it'll reduce the deficit by about $300 billion, which is the largest deficit reduction since 2011. If you look out 2 decades, that number is probably something more like 1.5 trillion of deficit reduction. That's not going to fix our debt, just like this isn't going to fix inflation, but it's going to help with our debt, just like this is going to help with inflation.
Marc, I wonder if you can speak to the Republican argument or critique to all of this. Now, they've talked specifically about the 15% corporate tax rate, saying, look, if you tax higher, that obviously pulls back on CapEx. That's going to bring down supply. That they argue that that's actually going to be inflationary. How do you respond to that?
By that argument, raising interest rates would be inflationary because raising interest rates also reduce investment. The reality right now is that the economy is overheated. We have too much money chasing too few goods. There's lots of different ways we can take care of that, not just on the corporate side, but on the individual side from healthcare. There's lots more we need to do, but this is a piece of the puzzle, and this is going to help get inflation, help make it a little bit easier for the Fed to get inflation under control.
How about the carried interest aspect of things that's got a lot of attention from hedge fund managers, maybe Wall Street-centric people? This is something that many iterations of legislation have attempted to tackle here. Do you think that this is a pretty substantial shot at, actually reforming the loophole, as some have described it?
Yeah, look, we can either fight inflation, reduce healthcare costs, and reduce the deficit, or we can do what the special interest wants, leave every loophole that's in effect, keep drug prices high. I vote for taking on the special interest, closing that loophole. In fact, there's many more loopholes we should be closing as well.
Marc, I wonder if we can kind of sort of narrow this down for sort of the average household, the average consumer who's saying, okay, so what does this all mean? You've got a study coming out from Rewiring America, which we should say was involved in the discussions for this bill, who say that $1,800 is the saving for an average household. And they specifically calculated the tax incentives on the energy portion of this, whether it's the EV credit, whether it is, for heating at home. How do you think our viewers should be looking at that part of this?
Yeah. So in the near term, people are going to see some of their costs go down because of lower energy costs and because health premiums aren't going to rise. That's not actually anti-inflationary in itself, but it can be anti-inflationary to the extent that those things are paid for, so they're not putting more money in the economy, and to the extent that they help with expectations. So people may see some immediate sticker price relief, and the hope is then that turns into actual inflation relief where prices stop rising even without needing these subsidies.
Marc Goldwein, Committee for a Responsible Federal Budget, Senior Director of Policy. Appreciate you joining us today.
For more on the markets, let's bring in Barry Bannister, Stifel Chief Equity Strategist, to talk about what we're seeing in the markets. Barry, good to see you. Are the markets kind of taking a second look at earnings and what might be ahead from the Fed?
Well, clearly the Fed in their meetings switching from a forward guidance model to a data-dependent model. In other words, they communicated to the street less of a desire to cause a recession to get inflation down, and that the market was able to switch its focus to what's embedded in the market, such as the Treasury curve. The Treasury curve had inflation coming down quite sharply. So by taking down some of the real yield premium from over tightening by the Fed, the market was able to reprice assets upward at that lower discount rate and that lower alternative Treasury yield. Remember, if you buy equities, you're taking risk. If you buy a Treasury, it's not a default risk. So therefore, you compare your returns on equities to your returns from a risk-free Treasury securities, in this case, the real 10-year yield or TIPS yield. As far as earnings, they were good compared to what some people expected. I've been more concerned about 2020 environment. A lot of companies make money and they're able to raise prices and offset some of the cost pressure. So generally speaking, it went the way we expected. We had been looking for a relief rally. Our target was 4,200 since the S&P was around 3750.
So Barry, given those signals that you're watching, then how would you characterize how the market is digesting each of these data points that are coming out and all this discussion about the definition of a recession? How does that play into your strategy right now?
Yeah, COVID policy was extraordinary. I mean, I railed about it last year. I could not believe that QE was continuing a year longer than it should have. We wouldn't have $2.3 trillion, that's 2,300 billion sitting in overnight reverse repo at the Fed if they weren't taking money out of the drain that they had just put in through the faucet. We wouldn't have $5.2 trillion appropriated in just 12 months from March of 2020 to March of 21 in fiscal federal COVID assistance. That's more money than we spent on World War II and the Marshall Plan to rebuild Europe in inflation-adjusted terms. That's a huge amount of money. So all that money is like a shock absorber. And the Fed starting from such a low level gave us a little bit of cushion. And so, you know, on the one hand, it was bad because it was extremely bad policy, what they spent and what they did. On the other hand, it's good because it gives us a cushion against a reversal of fortune in terms of those fiscal and Federal Reserve factors.
Well, Barry, looking at inflation today, comparing that to what it was a year ago by the end of the year, and currently with the Fed's policy and what we see likely from the Fed over the next couple of months, how significantly do you see inflation easing by year end?
Well, as you know, the Fed looks at core personal consumption expenditure deflator, or PCE. It has different weightings in some areas, particularly in things like rent and services from the CPI. But the CPI is what the 10-year TIPS Treasury market rebases to, right? So you buy a TIPS yield, you get your principal rebased to account for CPI inflation, CPI all items. So if you break out the CPI, it's it's four things. It's goods, services, energy, and food, the way we do it. We see relief on energy The global economy has slowed. That has always lowered the oil price. And inventories look like they could rise in our model. So that would help bring down oil and energy. Food is energy. I covered agriculture for over 20 years. So when you look at raw foodstuffs and transportation costs, then food consumed at home within the CPI comes down. Goods prices went up to a 12.4 year-over-year rate in February of this year, but they're coming down sharply as demand normalizes for goods. You can't have a goods demand due to all that COVID stimulus stay so high above its 10-year trend line growth rate. So goods, food, energy, all coming down. And that's going to lower the CPI quite a bit and take some of the Fed fear out of the market, in addition to their change to data dependency instead of forward guidance. We're able to reprice assets upward.
So again, circling back to energy, WTI down about 5% and Brent down 4%. You think that will continue to come down? And we're talking about a Fed pause at some point in the near future, and when?
Well, it's two good questions. On the energy side, I mean, just look at the Chinese PMI manufacturing. It came out over the weekend, as it always does, first Sunday of the month. It was 49. It was a big disappointment. Fell below 50. 50 is the break point of a shrinking economy and a growing economy. China's got some problems, and it spills over to most of EM Asia on imports and exports to and from China. So when you look at oil demand, I think the outlook is not that great. We also saw some demand rationing in the U.S. market, for example, at high prices. People just drove less. People went to the office fewer times, and they remoted in more often. So I think oil comes down. I mean, I'm using somewhere around 75 in the first quarter of 2023, perhaps 85 by year end. I'd like to see a movement towards a Ukraine ceasefire deal. And so there's a lot of geopolitical analysis going on in there. And then, you asked me, I think, about earnings, or I'm sorry, I lost the second question.
The Fed pause as a result of inflation pulling back, yeah.
Well, the Fed pause is an interesting question. The effective Fed funds rate's around 2.3, and they believe that they've hit their long run average of what neutral rate would be. The neutral rate is the rate that's neither tight nor loose. It's a borderline or a fence line between tight and loose policy based on the long-term potential growth of the U.S. economy, which is nothing more than the sum of productivity and population and labor force growth. But I tend to agree in some sense that long-term, I think it is the right rate. Short-term, maybe not. The neutral rate's probably a little higher, but they're willing to let inflation come down. So if the Fed pauses, it would probably be in the fourth quarter, sometime between that September-December meeting, of course. I had thought, originally November, then I said December. Now I could see 50 in September and then a pause. At such low interest rates, does it really matter? I mean, you're discounting the time value of money. So if you move the date of the pause 1 month either way, it's not going to change the DCF or the discounted cash flows in your valuation models for the market. Wait for the data to come in. Remember, monetary policy works with a lag. And so they know that. They're not ignorant. They're very bright economists. So they know that they've done a lot. And now it's time to step back and see what they did in terms of the effect on the market. If they have to hike again, they'll start up again in 23. But they've done a lot so far to get to the mid twos.
And Barrett, you mentioned some of the headwinds that you're expecting in 2023, especially when it comes to earnings. What are you keeping an eye on there? And perhaps at what point in 2023 do we tend to see some sort of normalization?
Mm-hmm. Yeah, I've been an analyst for almost 40 years, an analyst or strategist. And I've learned that the smartest people in the room are usually the bond people, not us equity people like me. And when the bond market inverts the curve, meaning the short rates 2 years, 3 months goes above the 10-year, for example, it has been an incredibly reliable forward forecaster of a recession. And when the 10-year, 2-year curve inverted on the 1st of April, it was a big April Fool's joke on us because since the 45 years ago in the mid-1970s, whenever the 10-year, 2-year inverts, you have a countdown of 14 months plus or minus 5 months at one standard deviation. On 12, on all these recessions, a countdown of 14 months plus or minus 5 to a recession. So it said, guys, you are going to be in a recession in June of 23, plus or minus 5 months. And we may bounce. We may try to avoid it. The Fed may cut. We'll see. But they're not going to be able to prevent the outcome if that's what the bond market has said. So curve inversion gave me a lot of worry about mid-23. But now I know that the market's horizon is about 6 months. It's never really been more than 6 months. In fact, you look at the market falling off before a recession, it's typically 1 or 2 months before the recession starts, and then it's declared 8 months after it began. So we know that it's going to take a while. But the second half looked like it was ripe for a rally, and we're going to play it.
All right. Well, we do appreciate your insights there. Barry Bannister from Stifel, thank you so much for joining us today.
House Speaker Nancy Pelosi expected to land in Taiwan imminently. It's the highest level visit to the nation since 1997. The trip has proven highly controversial. It comes amid deteriorating relations between the world's two biggest economies. China has warned the U.S. that it will, quote, pay the price for any visit. Joining us to weigh in is Council on Foreign Relations Research Fellow David Sachs, who has written extensively about this topic and about China topics generally. David, thank you so much for being here. We've been trying to sort of piece out what Pelosi's visit is trying to achieve. Is it legacy burnishment, which you suggested in a recent article could have waited until after the midterms? What do you think she's trying to achieve, and what do you think she will achieve?
Yeah, I mean, I think a lot of it is trying to burnish her legacy. If the polling that we see is correct, she won't remain the speaker after the midterm elections. Her position on China has been consistent, and she's considered quite hawkish on China, going back to when she unfurled a pro-democracy banner at Tiananmen Square decades ago. And so this is largely consistent with her criticism of China and support for Taiwan over the years. I think she likely also felt a sense of urgency to do it, given what's happened in Ukraine. A lot of analysts have drawn comparisons between Ukraine's position vis-a-vis Russia and Taiwan's position. There are certainly some similarities there. And I think that she felt it was important to show solidarity with Taiwan, and that the United States supports Taiwan as China increases its aggression and coercion towards the island, and as we remain focused on Ukraine.
And so additionally here, this comes as there is going to be the party Congress for Xi. So discuss the timing there for us and the implications that could also come as a result of that timing.
Yeah, so Xi Jinping is going for an unprecedented third term as leader of the Chinese Communist Party this fall. Basically, every analyst expects that he will receive that third term, but there's still a lot of negotiations happening behind closed doors within the Communist Party over whether he can promote certain allies or whether he has to take certain rivals with him to the top decision-making body. And so I think at this time, he is obviously trying to set a narrative that he's not weak, that he's fully in control, especially in control of China's most important relationship, which is with the United States. And so in my view, a lack of a Chinese response right now is not really in the cards, because Xi Jinping doesn't want to risk looking weak. And so I think China will err on the side of overreacting to Pelosi's visit rather than underreacting just for domestic political considerations. We also know that there are significant economic headwinds right now in Beijing. There's pushback to Xi Jinping's signature zero COVID policy. So he could also find it useful to kind of rally the Chinese people around the flag, around a shared threat or a shared challenge to China by the United States and Taiwan.
David, that overreaction response that you mentioned, what would the implications be to American companies operating in China?
So we've already seen the beginning of a Chinese response. Taiwan so far is bearing the brunt of that response. The PRC announced overnight that it is barring over 100 Taiwanese exports of the agricultural and food space. They also announced significant military exercises opposite Taiwan and are challenging the median line, a line in the middle of the Taiwan Strait where, generally speaking, China and Taiwan do not operate militarily over that line. And there was a significant cyber attack as well on Taiwan's government websites this morning. So I would expect that to continue with China trying to squeeze Taiwanese businesses operating on the mainland. I think that'll be a major thrust of their campaign. It'll be economic coercion. It'll be reducing market access. It'll be making lives more difficult for Taiwanese businessmen on the mainland. But in terms of what it means for U.S. companies, I think everybody, of course, is going to be focused on semiconductors, focused on Taiwanese exports to the United States. And one thing that I would say is if the PRC does significant missile tests, for instance, in the Taiwan Strait, essentially closes down the Taiwan Strait to international shipping because of military exercises, then of course that will ripple through global supply chains, given how reliant companies around the world are for Taiwanese inputs, above all semiconductors.
So David, obviously some really far-reaching implications of all of this. Fast forward 6 months from now, where do you think this relationship is going to stand between the U.S. and China, with, of course, Taiwan as a part of that? And then what are the implications of that?
Yeah, I don't think that the U.S.-China relationship is going to get better in the next 6 months. I also don't think that we've seen the bottom of the relationship yet. President Biden did hold over a 2-hour conversation with Xi Jinping, but according to reports, it was quite a tense phone call. And so I don't think that we have found the bottom here. The U.S. is going to continue to show support for Taiwan. I also think that the Chinese reaction will, in the long run, be counterproductive to its interests because it'll only prompt the U.S. Congress to do even more to show its support for Taiwan. So, I think that we could be in for a crisis. And the other thing that I would say is that I don't think that we will know the full implications of this visit on Thursday or Friday of this week. I think this will play out over a course of months. So China will unveil a response this week. And as I said, we've already seen the beginning of that response. But I would expect that China continues to respond to this visit well into the fall and winter. And there are certain things that it will announce, certain measures it will take coming out of the Party Congress that we will eventually trace back, I think, to this visit as well.
David Sachs, Research Fellow at the Council on Foreign Relations. Good to see you. Thank you.
House Speaker Nancy Pelosi landing in Taiwan earlier today, despite warnings from the White House and stern criticism and threats of countermeasures from the Chinese government. Joining us now to discuss this and the latest out of Washington is Senator Jon Tester of Montana and Yahoo Finance's Anjali Khemlani. As Senator, it's great to see you. I want to start with an op-ed that Pelosi wrote, and Senator Nancy Pelosi wrote in the Washington Post today, justifying the trip. And she said, quote, "We cannot stand by as the CCP proceeds to threaten Taiwan and democracy itself. Indeed, we take this trip at a time when the world faces a choice between autocracy and democracy." Now, Senator Tester, a number of members of Congress have visited in the past ahead of Speaker Pelosi. Biden, though, the Biden administration was very fearful and didn't want to endorse this trip. What's your reaction to her actually taking the trip? And do you think the Biden administration needs to have a tougher stance when it comes to China?
So, first of all, I think that the speaker is the speaker and she will do what she wants as far as travel goes. I think most people in the United States would agree with the statement about this is about democracy. And, all the time I was growing up, I learned about Taiwan and Formosa and the fact that these were allies. This country was an ally of the United States and continues to be. But look, you're dealing with a superpower in China that could potentially do some provocative things, and then we'd have to respond. So it has a potential to escalate. What I think the speaker's already done is probably had some people give her some analysis on what the threat could be with her visiting Taiwan. But she's been there for about 4 hours now, and So far, so good. And I do think it does send a solid message that the United States is still in the business of democracy, which I think is important.
Sends a bit of a message of a lack of coordination and communication between the Speaker of the House and the administration. It was strange on that note. But Tom Friedman writes in the New York Times, Senator, this morning that this trip by Pelosi is utterly reckless, dangerous, and irresponsible. Senator Bob Menendez was there 4 months ago. A House congressional delegation was there less than a year ago. Do you agree with that characterization that it's reckless and dangerous?
Well, look, I think it comes with some dangers, but on the other side of the coin, it comes with our ability to help promote democracy around the world. Look, if this thing ends up going bad, people look back and say this is a horrible thing to do. But in the end, you're right. There's been a lot of other folks that have traveled to Taiwan. There's been plenty of representatives from Congress that go there, and I think the fact is that what makes Nancy Speaker Pelosi different is she's third in line of the presidency. She's got a fair amount of stroke around this place. And but in the end, I think it's her call. She's made fully aware of the same classified briefings I get as chairman of the Defense Appropriations Committee. And she will do what she thinks is best. And I think that's what she's done.
And we know that this is happening while the CHIPS Act is preparing to be signed by President Biden right now. We know that competition with China also at the forefront, and also potentially tariffs as a way to try and help with inflation in the U.S. What is your take on how this dynamic, you think, will impact the U.S. economy?
Well, I think it's going to be positive. The CHIPS Act will be very, very positive for the United States. I think it'll get more manufacturing, particularly in the area of chips, back onshore. I think that's really important. I think we're seeing a lot of production limitations due to our lack of availability of chips. And I think this bill that was passed, if I had any negative sentiment towards it, it's that it wasn't done a year and a half ago. The truth is this is a good bill. I think it's well thought out, certainly bipartisan in nature. And I'm glad the Senate passed it last week. And I look forward to getting it implemented, getting more manufacturing within our borders and not have to depend upon other countries for critical supplies like chips.
Senator, I want to get your thoughts on the Inflation Reduction Bill. The Wharton model saying that it won't have an impact on inflation. The Biden administration saying the direct opposite. What's your view of this bill?
So I've been really focused on the toxic exposure bill for the veterans, but I will tell you and I've got more work to do on the Inflation Reduction Act. But there are some things in it that appeal to me that I think will result in a reduction of the inflation numbers. Number one, $300 billion pay down in the national debt is significant. We haven't seen that kind of reduction in national debt since Clinton was in office, okay? Second thing is, since my days in the state legislature, which is over 20 years ago, I heard about we need to have Medicare to be able to negotiate drug prices. That's in this bill. That's really important. There's areas in energy, and I can tell you that I farm in north central Montana. Climate change is unequivocally real. But I don't think this bill picks winners and losers. It's going to increase production both domestically in conventional resources and in renewable. And I think that's a positive. And I think there's some other things, but like I said, I will delve into it more as soon as we get this toxic exposure bill done and be able to give you a firm John Tester's a yes or no, this is a non-starter. But I think those three things alone, increased production in energy, negotiations for prescription drugs, and paying down the debt are all anti-inflationary measures, and I think they make sense, and I applaud that effort. Now, we'll see what else is in it.
And I think you mentioned there the PAC Act, which is getting money to veterans that have been exposed to these fire pits while serving our country. And look, Pat Toomey has taken a lot of incoming on this. All he is saying, as you know, is he doesn't want this to be annual automatic spending. He wants it in the discretionary category. You called this an 11th hour act of cowardice. Doesn't the Department of Veteran Affairs already have the ability to cover these veterans that were exposed to fire pits? And why do you object to Toomey's one carve out there?
Well, because number one, he's claiming there's a $400 billion slush fund. There is not. Number two, Congress has control over all the appropriation spending. And I think Toomey, who is a good friend and he's smart as a whip, is going to be leaving this body, and he wants to make future Congresses subject to his will. Look, I think the Appropriations Committee takes the president's budget. We either pull money out of it or add money to it. And in the end, it's our call. Congress does that. That's our job. And so I think the premise by which these amendments are put forward, that we're probably going to get a vote on today, at least I hope we do, I think it's a flawed premise. And I think if we're going to move forward and take care of our veterans who have been exposed to toxins due to burn pits and Agent Orange and radiation, as this bill does, I think it's important we let the veterans know that they're not going to have to come back to Congress and fight every year. And that's why it's important Congress does it and not the VA. Another administration, if the VA does it, could pull those benefits. If Congress does it, they're dependable, they're predictable, and the veteran knows they can depend upon them.
Senator Anjali here. We're really taking you across the spectrum of topics here, but now to your sweet spot of food. I want to talk about, you mentioned the drug pricing, and I know there's a lot of focus on that and the impact to the pharmaceutical companies. But another part of that conversation has been in the healthcare space, the impact of food, especially food and farming programs, farm to table, pharmacy prescriptions that recommend food for those who don't have access to it. And that's something that millions of dollars have been poured into over the years. And I know that you've talked about specifically the health of foods, and especially with hybrids coming into play. So I want to bring that all together, specifically on the hybrid part of it. You yourself as a farmer know very well the impact of this, and you brought up at the FDA commissioners hearing about the fact that we don't have studies and don't know the impact of these foods that we are recommending people get. So I just wonder, is there a void that can be filled with this, a bridge that can be, a gap that can be bridged when it comes to this conversation?
Absolutely there is. I'm one who believes that food is medicine, and that if you eat good food, you've got a much more likely possibility of staying healthy. I raise a lot of wheat on my farm, and we raise a lot of wheat in Montana, and wheat is the staff of life. And if the new hybrid varieties, and I'm not saying they do, but if they don't have the same inflammation reduction qualities as the old turkey red that my grandfather raised, then we ought to fix it. What I'm really saying is it may not. We don't do the testing to find out. And I think it's really important because hybridized wheat does a lot of good things for us, all right? Protects me from sawflies. You get an earlier harvest, so it can help with drought. There's a lot of really positive things that hybridized wheat does. But in the end, we need to make sure that this wheat is wheat that has been the staff of life from the beginning of mankind and will actually help make us healthier and not do something different. And so all I'm asking for is, shouldn't the FDA at least take a look at some of this stuff to make sure that the food we're getting on the grocery shelves is the food that'll make us healthier and reduce healthcare costs and improve our quality of life? That's it. I'm making no judgment whether it's right, wrong, or indifferent. We'll let the scientists do that.
Absolutely. And to that point, in 2018, the Farm Bill included $25 million for these programs, and that is supposed to be increased to $56 million by 2023. So with all of this money being poured in, do you find that Congress could play a role in sort of emphasizing these and investing more, to your point, of reducing healthcare costs over time?
I do. I can tell you those studies I have not seen the results of, and that's probably shame on me. I've got to dig into those to see what kind of research has been done. But in the end, I think Congress can play an incredibly important role. I mean, we can help push the agencies to do the work they need to do. And I think that the head of the FDA was very open to this kind of stuff, being a heart doctor himself, and understands that food can really help reduce doctor and healthcare costs and improve quality of life. Now, there's some other things that go along with that too, like exercise and good mental health and those kind of things, but food is pretty basic.
It's true. We're made of nature. It makes sense that nature will also help heal you. A big thank you for this wide-ranging interview, Senator Tester there, and our very own Anjali Khemlani. Thank you both.
Starbucks is out with a better than expected earnings report as it eyes a key investor day in mid-September. But with the coffee chain seeing squeezes in the U.S. from unionization efforts and in China from COVID lockdowns and globally from rising costs, Starbucks is set to double down on its reinvention plan set to take hold in 2023. Let's dive into the earnings with Rachel Ruggeri, Starbucks CFO, and our very own Yahoo Finance's Brooke DePalma is here as well. Rachel, I'll start with you here. Looking at the transaction growth in the U.S., it's slowed in this current quarter from the previous quarter. Is that the first signs of the consumer pulling back on their spending and pulling back a little bit on going to Starbucks?
Actually, we see it as quite the opposite. What we saw in this quarter is we saw the highest number of customer counts that we've ever seen, and we see the highest average weekly sales that we've ever seen. And so what that means for us is more customers are connecting with the brand, and they're engaging greater when they come into our stores. We've seen a little bit of a shift in terms of the composition of our revenue since the pandemic, and what we're seeing is higher ticket and a more modest transaction. So, we look at that as just a difference in how our customers are choosing to come to us. And, it speaks to the demand that we're seeing, and we're incredibly encouraged by it.
Good morning, Rachel. Great to speak with you. Brooke here. I just want to emphasize and dive into that a little bit deeper. Cold beverages were really a highlight here in the U.S. They made up 75% of sales. Howard even highlighting, saying all bets are off in terms of operating leverage, in terms of cold beverages there. But where exactly do you see the long-term growth here in the U.S.?
Well, typically, cold beverages at about 75% of our business is typical in this quarter. So that's a 12% increase from prior quarter, but that's our typical seasonality. And in fact, we're in line with where we were last year. But the way we see cold and the opportunity around cold and all our beverages, frankly, is our ability to continue to create more premium offerings with an opportunity to customize. The ability to personalize drinks is what we think helps differentiate Starbucks. It gives customers a choice and allows them to express themselves, through a drink that is suited for them. I'm a particular heavy ice drinker, and so being able to have that personalization, we think, has a lot of opportunity for us in the future.
It's amazing to kind of hear about some of the fluctuations that we're seeing throughout this earnings season, especially on the international frontier. And this is particularly important for Starbucks as well in China, significant because of so much of the rate of store openings pre-pandemic. And even now, you're looking across some of the headwinds, the lockdowns, and even that knock-on revenue contribution as well. And so when you think about this region and when it will reach reliability in terms of some of the broader growth metrics that Starbucks has, what time frame are you looking at?
It's really hard to determine what the time frame will be. I mean, definitely this recovery is nonlinear. But I think what gives us some encouragement is as the mobility restrictions have lifted more recently, we've seen sequential improvement in our average weekly sales, sequential improvement in our comps. And that speaks to not only the power of the brand, but also speaks to the resiliency of our partners in the market. We have incredible partners in the market, and that's coming through. We also look to our other international markets as a proof point. And when we look at our market like Japan, as an example, which is our third largest market, in Japan, as restrictions have been lifted, we saw an incredible quarter this quarter in Japan, and a lot of that comes from recovery consumption. We saw that in the U.S. a year ago in Q3 when, people were able to get out and about. And so we're benefiting from that. And we saw that in our international markets outside of China, with every single market showing growth. And it was really all in transactions. And a big driver of it was the recovery consumption. Another big driver was the opening of travel. But I think what it speaks to is that it shows that when we are able to be out and about, customers want to come to Starbucks, and our job is to make sure that they come in and, more importantly, that they return.
Rachel, it's Julie here. I want to take a step back and look ahead as well a little bit to what we're going to be hearing from the company in September at that Investor Day. Howard Schultz on the conference call talked about perhaps some of the missteps that the company's taken in the past. He said some of it has to do with COVID, right, and was not things that the company did. But he said, unfortunately, many were self-induced. What needs to be fixed at Starbucks?
Well, really what we're realizing, particularly through our listening and co-collaboration sessions, is that we have to create a better experience for our partners, first and foremost. And that comes in a lot of different ways. We need to create a better experience in terms of the stores. So even though we've got this great demand and we're servicing all this customization and personalization, it's hard on the partners. And so our opportunity is create a better design in the stores, whether it's through more efficient equipment, whether it's through different operating practices, whether it's through an absolute design change. It's a combination of all of of that will make it more efficient and less complex in our partners serving our customers. In addition to that, we have to make further investments in our partners so that we can continue to be an employer of choice. And we've started those investments with the wage move that we just, on 8/1, we took the last of our wage move for this year, where we've gotten all of our hourly partners in the U.S. to an average of $17 an hour. We've also increased significantly our training and more modernized training so that our partners feel that they have what they need to be able to support our customers and, these more personalized beverages. We have, ways ahead of us, but we're encouraged by the investments we're making and some of the green shoots we're seeing in terms of a slight reduction in some aspects of our turnover, as well as a slight increase in our partner engagement. But that's really our opportunity, is to create the very best experience for our partners, because we know that in turn, they'll create the best experience for our customers. And that is really what differentiates Starbucks. And so that's where we're focused, and that's what we've learned and where we've decided that it's most important that we focus not only now but going forward, and ensuring that we never lose sight of that.
And I want to dive into those wage hikes that went into effective August 1st. Of course, those wage hikes will not be effective at the stores that have voted yes to unionize. So I'm curious, how exactly do this trend of unionization efforts, as well as those wage hikes, impact Starbucks' bottom line here?
Well, what I'd say in terms of the wage hikes in general, they're part of what we're guiding for Q4 and going forward. Now, going forward, as we'll share more at Investor Day, as we make investments in our business, we're choosing to make investments that will drive an outsized return. And so those investments will help us strengthen our business over time. And that'll come in the aspects of reduced turnover, increased partner engagement, in a more stable and more efficient operating environment. That's going to help us create a better experience for our partners, which is the most important, but that in turn will lead to better overall profitable growth. And we have evidence today in stores that we have, throughout our over 9,100 company-operated stores, we have evidence today where when we have lower turnover, we see higher partner engagement, and we see customer and operational and financial metrics that are better than the peer set. So we have proof point to that these are the right investments to be making, and that'll help us strengthen the business over time. And in regards to what it means, broadly to the company, I would just say, we continue to focus on creating the very best experience for our partners. It's served Starbucks well for over 50 years. It's what creates value for our customers and for our shareholders. And it's important for us to be able to attract and, importantly, retain the very best partners that we can have.
Rachel, of course, a lot of your partners want this process to be through a union. Is Starbucks anti-union?
My answer to that is that, we still firmly believe that the best relationship we can have with our partners is a direct relationship. But we respect the process, and we're focused on creating the very best experience. And as I said, that's really largely what our reinvention plan is centered around, is creating that partner experience and ensuring we elevate that so that we can be competitive and we can maintain a competitive advantage so that, again, so that we can attract and retain the very best partners.
Rachel, Starbucks pulled its guidance several months ago, but are you happy where street estimates are going into that September 13th Investor Day?
Yes, we'll see what happens for Q4. As we shared on the call yesterday, we're encouraging, even though we're not guiding, we provided some perspectives that will have further pressure relative to Q3, largely due to the timing of the recovery in China, as well as the fact that we're not seeing our inflationary pressures soften. They're not furthering, which is a good sign, but they're not softening, and so we'll see them more in line with Q3, which is elevated versus prior year and elevated versus Q1 and Q2. So, that gives us some encouragement. And importantly, what we're very encouraged by is the fact that we were able to over-deliver on our expectations this quarter, because it gave us good confidence of the fact that we can deliver even as we're executing upon these planned investments in a very dynamic environment.
But for now, we got to refocus on this jobs report because as we've been talking about, the U.S. added a stunning 528,000 jobs in July, exceeding estimates of 250,000. Joining us now for a deeper dive on the labor market is U.S. Labor Secretary Marty Walsh, who talks to us, as he always does, after the jobs report. This is a particularly good one, though, to talk to you about, Mr. Secretary. So talk to us about where we are seeing this strength, what you are hearing from corporate leaders, because we just are getting through earnings season. There's a lot of trepidation out there that doesn't seem to square with this big number.
Well, I'll tell you, this is probably one of the best interviews I want to do today because the 526,000 jobs overestimation is great, but more importantly, when you look at the whole picture as a whole, we're seeing all of the sectors have come back to pre-pandemic. The unemployment rate's actually a little lower today than it was the day before the pandemic hit in the United States, which we had a pretty strong economy back then. We're seeing great gains in manufacturing. Manufacturing is not only back, but are exceeding where we were. And then when you think about the CHIPS bill that the president's going to be signing hopefully next week, we're going to see more manufacturing happen in the United States of America on semiconductors, and long term that will help us in inflationary pressures, being less dependent on foreign imports coming into the country. We saw gains in education. I think part of that was what I would assess that as is last year this time, schools around America and cities and towns weren't hiring as much because they weren't sure what the school year was going to bring. Now there's a lot more predictability. People have learned how to live with the pandemic, live with the virus. There are safety precautions in schools, and schools are staffing up across the country. We're seeing all of that. And then obviously we still know, you talked about gas prices. We've seen a decline for 7 straight weeks in a row. It's the largest decline in the last decade, but still people are looking for more return back into their pockets. So the president released some oil reserves and also working right now with Congress to pass the Inflation Reduction Act that's quite honestly being debated in the Senate right now as we speak. Well, not right now, but they're talking about it behind the scenes. They're going to have a debate, I think, in the next couple of days, hopefully.
Mr. Secretary, is this report, the jobs report, so strong today that we just need to bury once and for all that the economy is headed to a recession?
Yeah, I don't want to say it's not, and I don't want to say it is, because I personally don't think it is. I think that, when you talk to companies, when I go around America and I talk to businesses and companies, they're hiring, they're looking to expand, they're looking to grow. Last year, we saw 5.2 million people start their own business, entrepreneurship. Some of those companies are still in existence today, and they're going to grow. And I think we need to continue to focus on making investments in supporting American businesses to continue to grow, whether it's in the manufacturing sector, the retail sector, the leisure hospitality sector, in these other sectors that we have in the country, the high-tech sector, the biotech sector, all these different sectors we have. I think these companies want to continue to grow. And I think, one thing I was on a call this morning and I said, I kind of look at this through my lens of being my old job. I don't look at it as being the Secretary of Labor. And I think about cities and towns all across America, and governors in states want to continue to grow. And I think we just have to continue to focus on that and do everything we can to reduce inflation. I think the president laid out a plan 2 years ago to get America back to work. 10 million Americans almost have gone back to work under his tenure. Last year, he laid out a plan to deal with inflation. We're working on bringing those costs down, those pressures down. This administration, the Biden administration, did not cause the inflationary pressures we have. We can't lose sight that a lot of it was because of a pandemic and global supply chains and issues around the globe and the desires for people wanting things. So we're going to continue to move forward, and hopefully in the next several months we'll be on this call talking about our inflation coming down and our economy continue to be very strong.
Fingers crossed, for sure. I want to ask you about another phenomenon and whether you are hearing about this in your travels and in your discussions with CEOs. And that's something we've begun to talk about, which in past, as companies prepared for recessions in the past, they started cutting pretty quickly and pretty broadly. That's not necessarily what we're seeing this time. We're hearing from companies, maybe they're slowing hiring, maybe they're doing targeted cutting because they don't think if there is a downturn that it will be that severe. Is that what you're hearing from people as well? They're reluctant to lay off people?
Yeah, when I'm talking to businesses all across this country, they're just talking about there could be a recession looming, but they're also, like you just said, they're adding to the bottom line. They're continuing to grow. They continue to add people on. I guess some of the bigger companies are slowing down a little bit in hiring, but when you look at 500,000+ jobs being added in 1 month, the slowdown is very incremental, obviously, but there are still other areas for growth. So I think what everyone's kind of in the business community and in the world is a wait and see approach to see how we move forward and what's happening. Again, this is a very different time that we're living in than I was a legislator in the last couple downturns where we actually had recessions, where we had to raise taxes and cut benefits and cut programs. That doesn't have the same feel as right now.
We'll leave it there. U.S. Labor Secretary Marty Walsh, always good to get some time with you. Have a great weekend.
Thank you.